Hello and welcome to the show. I'm Kim Parley. Thank you so much for joining us tonight. Well, uncertainty around Brexit has left many investors wondering how they should position their investments. My guest tonight says he can't think of anything better than to own high-quality dividend growers. Joining me to explain what's been going on with the markets is Damien Fernandez. He is manager of the TD Balanced Growth Fund and co-manager of the TD Tactical and TD US Monthly Income Funds. You're busy, you're managing a lot of stuff. Thanks for taking the time to come in.
Thank you, Kim.
I want to start off by giving the point of what we're going to be talking about in the next little while, and that is that you believe the place to be is in high dividend growers.
Exactly.
Okay. Now you're going to take us through the reasoning of how we got there right now. What's been going on in the bond market? Take us through that first of all, and then we'll kind of make our way into the equity market.
Look, the bond market for the past few years has been on a downward move because of what I'll call structural issues. Demographic issues. As people get older, activity levels are lower, so that weighs on economic growth. There's also high levels of debt. So these are reasons why bond yields have actually for the last few years been moving lower. But more recently, we had the Brexit scare. And that actually accelerated the move down in bond yields. So globally right now, we have 40% of developed market bonds. 40% of the universe of developed market bonds are yielding you below 0%, are yielding you negative.
Which is not funny. I mean, it's just mind-boggling, quite frankly, that you actually have that much of a bond market promising to say, if you buy this, you will get less money when you come back. So just so people understand, though, because the real reason yields have gone down so much with Brexit, partially, is because there's been this flight to safety. People are going in and putting their money into bonds. So you're seeing higher prices, right, in bonds at the same time. So people have seen returns on bonds in the past little while. They just haven't been getting it through yield.
Exactly.
Yeah.
So, but the thing is, at this juncture, when, for example, the German 10-year is yielding you -9 basis points, when the Japanese JGB, the 10-year JGB, is yielding you -30 basis points, it's hard to make incremental price gains from there because they will have to go even more negative.
Right.
Or conversely, if you look at the data, the US Treasury is yielding you 1.4%. If you generally bond, the total return you achieve as an investor over the life of that bond is the yield. So if you held that bond today, the US Treasury, and held it for the next 10 years, your total return as an investor would be 1.45%. That's it.
Yeah. Therefore, you have to go somewhere else.
Therefore, I think there should be a move towards what I'll call other income alternatives. And yes, there's corporate bonds, but those yields have come down. Yes, there's what I'll call alternative investments that have high yields. Those have also been suppressed lower. But I think equities, and particularly dividend growth equities, are one of the true places left that people should focus on, because if you're looking at quality companies which have, cash flows in stable businesses that are growing, those businesses are growing, those cash flows are increasing, those dividends are increasing, that is a great alternative. That's one of the best arbitrage opportunities around right now that I think is still underappreciated.
I want to let people know, too, in the next part of this interview, we'll be getting Damien to give us some names that actually have some interesting yields, so to speak, or returns for investors to look at. One thing that you and I chatted about before the show started, I thought that was fascinating, is that Brexit happened. And since Brexit has, come, and I won't say gone, but we're working through what the implications are, we've had all these headlines of, equity markets hitting new highs. And you point out, yeah, we were hitting new highs or just about to right before Brexit happened. So, we've seen this big turnaround right now, but what you've noted is that we've seen a much more of a bigger resurgence into bond prices than we have in equity prices.
Exactly.
So what's going on there?
So what's happened is that before Brexit, bond prices were already low. The Brexit did happen, and it was unexpected in terms of the outcome, and it was an adverse outcome. So bond prices were pushed lower. Equity prices initially corrected, but then I think people woke up and said, oh, look, the bond yields are at such low levels. When people talk about valuation, they talk about P multiples, but ultimately valuation is driven by discount rates. Kim, think about a discount rate as literally being the gravity that supports or anchors valuation. The lower the rate goes, the less gravity there is, the higher the valuation should be. So people are thinking here, oh wow, the discount rate, as you've talked about in these bonds, has collapsed. By definition, equity prices should move up a little higher.
And your thesis is that we're not seeing the equity prices catch up to that discount.
I think that's, look, Brexit was an exogenous shock to already a slow growth environment. So undoubtedly, your expectations for economic growth have to be revised lower. We can talk about why that is, but undoubtedly it wasn't a good outcome. But while your earnings estimates that are driven by global GDP growth, while those get revised lower, you also have to, I don't think people are adjusting the discount rate and how they're valuing equities. Because you cannot use the same discount rate before, because the discount rate in some cases has collapsed by 50 to 75 basis points. Right? As an example, the Swiss 50-year bond is yielding you negative 30 basis points. So for 50 years, as an investor, I have to pay the Swiss government 30 basis points a year. There's tons of Swiss companies, like Nestle, for example, that are yielding close to 4%, right, and growing.
Yeah. So why would you do there? Okay,
exactly.
Now we're going to get into some interesting high dividend growers that are out there.
Kim, I love the fact that you said high dividend growers and not high dividend yielders, because I think in this reach for yield.
But tell me what that means. Why?
Well, because like right now you have to squint to find yields. So that means people are getting pushed to search for yield.
Yeah.
So the first thing they're grabbing onto is high dividend yield.
Yeah.
But sometimes a lot of these businesses that have the highest dividend yield don't really have what I'll call quality franchises. They have high leverage, they might not have the best business models, but people are just blindly rushing into them. We actually prefer, we prefer to be in dividend growth from high quality companies. Names where the dividend yield might not be that high, and we can and a few names we have after, you can see the dividend isn't, alarmingly high.
They're bringing cash in.
It's growing. I'd rather have a stable, consistent, rising dividend flow than something that's really high, but it's at risk of going down.
Yeah, got it. Okay, well, let's take a look at that chart he was speaking of. We've got three names here that give you a sense of some of the yield levels he's been talking about, but what they've got in terms of the growing side. So Cisco, Medtronic, and JP Morgan. Dividend yields, I'll just let you go through them, but I mean, these are not double-digit dividend yields.
These aren't, and the most interesting column right there is the last column, right? So you have three names, for example, people focus on the Ps, and yes, the Ps are either, in JP Morgan's case, it's very attractively valued, sub 10 times. In Medtronic's case, some people might say that's expensive at 19 times. But look at the dividend growth of the last 3 years.
And that means how much the dividend has grown?
Dividend has grown. So put separately, for example, Medtronic, over the last 3 years, their dividend, they have given you a dividend raise, an income raise of 14%.
Every year?
Every year, year after year. In fact, Medtronic has done this for 39 years.
14%? They haven't done 14%.
They've done 18.
18 over the last 39.
Oh, it is. So the funny thing about Medtronic, and we can get into it, on Brexit Friday, it unceremoniously raised its dividend by 13%. And this was the 39th year of a consecutive dividend raise. We have a Medtronic chart. It is actually one of...
Let's actually, I think we've got... let's bring up Medtronic first then. So this is the dividend growth chart for Medtronic. And I mean, it's a nice steady line. I can see.
Yeah. So, the interesting thing about that is that the green line is the dividend yield. And, the dividend yield, will keep moving up. But that orange line is what I'm talking about. That's how much the dividends it's paid. And it is consistently, in a non-volatile fashion, just consistently increase the income you receive year after year.
And I just want to clarify for people who are thinking, wait a second, you talked about 13%. We're talking dollars on the left.
Yeah, exactly,
right?
We're talking dollars on the left.
And this is the dividend increase per year?
Exactly, the dividend increase per year. So Medtronic right now is only yielding you 2%, but that dividend is growing double digits.
Yeah.
Right. So if I think about a 3-year horizon, I can own a U.S. Treasury that is yielding me 70 basis points. So in 3 years from now, I'll get 70 basis points each year, and I'll get my money back. Or I can own Medtronic, which is yielding me 2%, that's growing double digits every year. So in 3 years from now, unless the stock price is lower, I get an increasing amount of income, plus likely in 3-year time period, we are positive on the stock. The stock price will be higher.
Generally speaking, I mean, because you don't know, but I mean, if dividends go up, that tends to be good for stock prices.
The stock price follows the dividend growth. Is how we think about it.
Let's look at Cisco here. You've got a graph here you brought in. This is the 10-year Treasury. We're looking at graphed up against the dividend yield of Cisco, which is currently yielding 3.5%, but 14.9% dividend growth over the last 13 years. Yeah,
that's amazing. So Cisco just recently started paying a dividend, and Cisco was written off a few years ago because people thought it wouldn't be able to compete, and software would eat its main revenue stream, or white label boxes. It makes routers and switches. But people forget that Cisco is still the biggest the biggest company that deals with enterprises. And as enterprises started needing more data, they actually started demanding more of Cisco's products. Cisco's done a few interesting things where they've moved to a service model. So their gross margins that people thought were at risk have actually gone from 60 to 65%. But ignoring all of the reasons why we're positive on the stock, Cisco is one of the highest dividend yielding stocks in the tech sector at 3.5. That dividend yield was just raised 26% more recently. This company is sitting with $35 billion of net cash. Pay off all its debts, a quarter of the company is in cash. So we're actually very confident both about Cisco's growth platform, but more importantly about Cisco's growth potential, dividend growth potential over the next few years. We think earning 3.5% versus earning in the US space, nothing really over 2%, and 3.5% and growing is a very attractive option. That's what I mean about dividend growth. It's really about the dividend growth that particularly when rates are so low and have been pushed lower, that that really captures our imagination.
What about, let's take a look at JP Morgan, because I know a lot of people are shy on financial stocks right now and just financials in general. We've got a chart here. It's the original one that we showed you of the three names, but JP Morgan highlighted here at the bottom, 12% dividend growth over the last 3 years.
I think JP Morgan, so first of all, taking a step back, people have been reluctant to look at banks because rightly so, they believe that as rates go lower, the money banks earn by lending will be reduced. Right. Net interest margin. Makes sense, right? Yep. But look, I work for a bank. Net interest margins aren't going negative. Importantly, JP Morgan's biggest customer base is the US. We just had jobs in the US that were up 280,000. We had the National Federation of Small Businesses today. That is starting to improve. Economic activity in the US is actually, improving. So while JP Morgan might earn lower net interest margins, it'll have more loans. So we actually feel pretty good about, just the overall business. But I think what people forget is that last week, in the midst of all of this Brexit, the Fed announced its CCAR. This is once a year, and the CCAR announcements are literally a regulatory framework for how much banks can raise capital. So the Federal Reserve has a stress test that under the most negative scenario where equity markets fall 50%, where unemployment goes to 10%, are these banks still solvent? And if the banks are solvent, they can raise their dividends, they can buy back shares. JP Morgan passed with flying colors. So not only do you have a 3% dividend yield, JP Morgan now is going to spend $10.6 billion on share repurchases, or about 4.7% of the shares are going to be retired. So now let's think about this on a one-year horizon. On a one-year basis, both the US and the Canadian one-year bond is yielding you about 50 basis points. On a one-year basis, I know in JP Morgan I'm going to get a 3% dividend yield, and I know I'm going to get 4.5% of the shares retired. So I'm going to get a 7.5% total return. So not total return, sorry, total yield from JP Morgan. And this is even after the most draconian stress test scenario that the Fed just, put them under. Yeah. To me, this is kind of very, and it's also an interesting hedge, right? Because if you're thinking that most people, and rightly so, are of the view that rates will remain and stay low. But in the event that rates do even start to move up,
you do get that upside.
You do get that upside. Yeah. So I think it has that optionality too with it.
Fascinating discussion. Damien, thank you so much for coming in.
Always a pleasure.
Damien Fernandez, he's portfolio manager of the TD Balanced Growth Fund at TD Asset Management.